Hello and welcome to Market Call on this Monday. We have David Burrows on the program for the next hour. He's President and Chief Investment Strategist at Barometer Capital Management. He's taking calls, emails, and tweets on North American large caps. If you have a call or an email or a tweet, there's the way to do it. Toll-free number, email address, the Twitter handle. You can also upload a video question by using the social media platform of your choice. Hello, sir. How are you?
I'm great, thanks. How are you?
I'm very well. So when we look back to August and September, does it just look like, I don't want to say garden variety, but it was a correction. That's what it was. Would you agree?
Yeah, no, we had a pretty firm view that we were in a bull market correction. You look at the S&P, it sort of went top to bottom about 12%. Bull market corrections are unique in that they tend, when you look at the index, to come out of nowhere. They're over very quickly. They scare the pants off of everybody. And before you know it, the leadership going in reestablishes itself on the way out. And I think it's so interesting that literally 4 days before that 1,000-point down day in August, consumer stocks, technology, financials were basically at highs. And here we are, when you look at what's happened since then, certainly the consumer stocks and the technology stocks have gone right back to the highs relative to the market in absolute terms. And there's a bunch of great companies doing very, very well.
So what was strong has become strong once again, and the weak sectors of the market remain the same?
It's always very interesting. When you get a correction, the weaklings off the bottom will always bounce, right? And often it's very sharp. But the question always is it short covering or is it real buying? And so I think maybe we said on the last show, it remains to be seen whether the bounce in energy, the bounce in commodities, the bounce in emerging markets is something that's sustainable or whether it is short covering. And if I look at the work that I do, in the last 7 or 10 days, the bounce in energy producers, for instance, has waned. And the bounce in commodity stocks have waned. The relative strength versus the S&P has hit new lows. Emerging markets have now hit new relative strength lows versus the S&P. The Canadian stock market has hit new relative strength lows versus the US stock market. So the old leadership is reestablished. The weakness, I think, has not shown that this is some change in trend. And so they're still in a market where there's very clear haves and very clear have-nots. And as a portfolio manager, that presents some opportunity as an investor.
How much does the macro picture concern you? Tepid growth globally, basically.
Well, look, when we went through the correction in August and September, there's no surprise that there's a view that concerns around growth in China and emerging markets. The concern was, could that wash through into the consumer-led economies, right? And so I don't think that that's an unknown. That's something that's been in the market for quite some time. And in fact, in September, the sentiment of emerging market investors hit the lowest point in the last 30 years. In fact, sentiment was worse in August and September than it was in the worst part of the crisis in 1998. So that's not going away. But at the margin, interestingly, the PMI data in China is getting marginally better. So if that's been the big concern and that data is slowly starting to improve a little bit or not getting worse, while the data in North America is steadily, slowly improving, then that should take away that fear. And there's no over-optimism in this market. There's no speculation. You look at the number of contracts outstanding in S&P 500 futures contracts in speculators' hands is virtually at zero. So it's not an over-owned market. And I think that probably this year finishes pretty strong over the next 2 months.
David, we're going to take a look at one of your funds in a while when we go to break, the Barometer Global Macro Pool. The returns are good. You're beating the Globe Alternative Strategies Peer Index. So what do you try to do within that fund?
So that fund looks across asset classes, and we make investments in asset classes and neighborhoods within asset classes, like sectors and themes, where we can see that things are improving and multiples are expanding. And it is a long-short fund, so we can be short asset classes like commodities or emerging markets that are relatively or absolutely underperforming. And we use ETFs to express our view, so there's nothing scary. There's no single stock risk. It's just targeting the right neighborhoods and avoiding others. And we've been fortunate. It's done quite well.
All right, David, we'll take a short break. As mentioned, that global macro pool at Barometer has been doing quite well. We'll see the returns here. And then when we come back, we'll get to your questions on North American large caps.